Okay, now we'll make this operating expenses budget. Okay, this budget is going to be something very straightforward and simple because, as we are given in the question, there's only one operating and distribution expenses, which is going to be 30% of the month's sales. So let's try to find out for the month of January, the February, and then the March. So we're going to need to have a sales revenue, sales revenue. We have 160,000. We have 2 lakhs. We have 2,40,000. As you can see, the operating expenses is 30% of the month sales. So we can write it like this: operating expenses at the rate of 30%. That's going to be 48,000, 60,000, and if we calculate 30% of this, is 72,000. So in total, we will have total sales of 160,000, 2 lakh plus 2,40,000. That's going to be 6 lakhs. That's going to be 30% of 6 lakhs is 180,000. So simply, this will be your operating expenses, the budget. So it's fairly simple. So we'll continue with this budgeted cash received and disbursement budget. So most of the time, often students find it difficult to make this budget, but it's relatively simple and easy to make. So let's try to find out this budgeted cash collection and disbursement. Okay, so in order to prepare this budget, we will have 3 months: the January, the February, and the March. So as always, we start with the beginning balance of cash, beginning cash balance, and as always, we go to our beginning balance sheet. On this part, we check the cash, and it is 10,000. So that's what we're going to have it over here. This is 10,000. So followed by this, we're gonna have to have, okay, all right. So we're gonna have to have this at the cash collection. So whatever cash collection that you might have, you need to have this in this section. So basically, for any typical either manufacturing company or the merchandise company, the basic, like the primary source of cash would be the sales. So first of all, we'd like to have this cash collection from sales. So we're gonna have to prepare the working note for this one, working note 1. So we'll go and prepare this working note. For us to have this, we have to have the question about the cells. Let's have it over here. Okay. Okay, what did we include all those? So let's have the part of question over here to prepare us the merchandise purchase cash collection think the information up to here would be good enough for us. All right. Okay. So, as a working note, we prepare this working note 1. This will be cash collection from sales budget. So one thing that you need to be mindful of this budget is the number of months that you are going to take. So as I've said, you're going to take all the months of the actual sales. For this case, it's November and December, and you're going to take the sales for the first 3 months of the projected period. The reason for taking the first 3 months only is you're being asked to calculate until the end of March, the projection till the end of the March. So we just take the sales until the end of the March, including those of the given actual sales. So let's take it. So it's the November, it's the December, it's the January, it's the February, and the March. All right. So first thing, we start with the sales revenue, the gross sales revenue. The gross sales revenue is 120,000, 160,000, 160,000, it's 200,000, that's 240,000. All right. Now we need to find out like what is the pattern of the sales collection. So these sales, as you can see, these are the gross sales, and the sales could be both in the cash or in the credit. So for this question, we are given with that most of the sales are on credit. So as you can see, this entire amount of sales is in credit, and the past experience of the company shows that the 50% of the credit sales are collected in the month of sales itself, and the remaining 50% are collected in the following 2 months of the sales equally. So what we need to make sure is, now since we already have the gross sales over here and most of them are credit, so we look forward to collect the credit sales. So write it, the collection of credit sales. All right. So it is going to be the collection of the credit sales, right? Let's put it more like this. If it is going to be the collection of the credit sales, let's see how many installments are going to be collected. So as we know, there are going to be 3 different installments, and the first being 50% on same month, all right? And the next 25% on the next month of sales, and the remaining 25% will be on the next following month of sales. It's pretty straightforward, right? So whatever the sales you have, you collect 50% of that, that is 60,000 on the same month. The 25%, that the 25% of this part will be on the next month. That comes around 120,000, 25%, that's 30,000. And the next 25% would be on the month after the sales. That is going to be again another 30,000. So if we do the same thing for the rest of the sales, we'll find that there's going to be 80,000. There's going to be 40,000. Another 40,000 on the following month of sales. Since it is also 160,000, it's going to be 80, the 40, and the 40. That's 100,000, so 50% of 100,000 is 100,000. 25% is 50,000. Another would be 50,000. This is 120,000. That 40, 25% of it is 60,000 on the next month. The remaining 60 on the following month. All right. So one thing that you notice is some amount is outside the budgeted box, right? All right. So how do we make it? Okay, let's make it like this. That's not V. I can do it. Okay. All right. So if you see this amount, which shows the amount of cells to be collected after the month of March, we show it as an accounts receivable. All right. Accounts receivable. All right. So now, since we have all the information in what is required, so let's try to sum it up to find out what are the actual cash collection from cells. So this is going to be cash collection from cells. So since we have the complete information only from the month of January, we'll make sure that we only add these figures here. So for the month of January, we have this amount, and this amount collected. So if you add that up, that will be 80,000 plus 40,000 plus 30,000. So that's going to be 150,000. So this is going to be 180,000. That is going to be 120,000, 50,000, and 40,000. So that's going to be 210,000. All right. So simply, these are the amounts of the cash collected for the month of January, February, and March, right? So we get this amount over here in our cash budget, right? So let's have it over here. All right, so I think it needs to be. Okay, let me get rid of this thing. 150,000, 180,000, 210,000. 150,000, 180,000, 210,000. All right. So since we already have the cash collection from cells, now if you add these up, let's try to find out if there's any other cash inflows with us. So as I see there are no any other cash inflows with us. So what we'll do is we add the beginning inventory with the cash collection from cells, then we'll get the total cash collection. Okay. All right. So for the first month of January, we can add these up, that we have the beginning cash balance of 10,000 and the cash collection from cells of 250,000. This is going to be 160,000. All right. So what we do is we deduct the cash disbursement. The cash disbursement means to say that whatever the cash that you're going to pay is going to be over here. So in this case, since this is a trading company, we first of all pay for payment for merchandise. Okay, let's read out how the payment of the merchandise is going to be done. So as you can see in this part, that all the purchases are paid on the following month of the purchase. As you can see, we already have the amount of purchase with us and the month. So this is going to be 100,000 on January, 120,000 in February, and 140,000 in March. So the payment would be that 100,000 of the purchase on the month of January will be paid on the month of February. That's 120,000 of the February will be paid on the month of March, and the 140,000 of the March will be paid after March. So this amount will be shown as accounts payable. All right. So as you can see, there's no amount in the month of January. So in this part, you'll make sure that you have the amount of the purchase that was made on the month of December, which is 80,000, and this will be paid on the month of January. So we'll have it over here as 80,000. All right. So after this, let's see if there's any cash outflow. So if we check our question, it says that all the operating expenses will be paid on the month when they become due. So there's the part over here. Expenses are payable on the month they become due. And the operating expense is 30% of the month sales, which I've already prepared in our operating expenses budget. So what we'll have is payment for operating expenses. So we have a monthly breakdown of the operating expenses over here. So we'll have it written over here in our budget. That's 48,000, that's 60,000, that's 72,000. All right. So is there anything else that we need to pay? I don't think so, except for the equipment. So let's pay for the equipment. As you can see that the equipments are being paid on the month of January at the cost of 10,000. So let's try to pay for the equipment. It's a payment for equipment. So that's 80,000 in the month of January. All right. So let's see if there's anything left. All right, I don't see anything else. There's a repayment or the disbursement. So what I'm going to do is I would add this up. As a total cash disbursement. So let's add it up. First one comes to 80,000 plus 48,000 plus 80,000 again. That's going to be 208,000. That's 260,000. That's going to be 192,000. All right. So as a simple rule, as we know, if we adjust this cash collection and the cash disbursement, we are going to get the net cash surplus or the deficit. All right. So if the total cash collection is more than the cash disbursement, we'll have a surplus. And if we are to make the payment, the disbursement, there's more than the cash collection, there's going to be a deficit. In this case, as you can see, we have 160,000 of the cash inflow and 208,000 of cash outflow. So 160,000 minus 208,000 will see 48,000 of cash deficit, 48,000 negative cash balance. So as we can see in the question that this company has to maintain a minimum cash balance of 10,000 in any given point of time. And if it is not being able to do so, it'll make sure that it goes to the bank and borrow the soft loan at an interest of 12%. Loans are to be taken at the multiple of 5,000 and the repaid at the rate of 1,000. And also the interest are to be rounded off to the nearest 100. So since we have 48,000 short of our minimum cash balance and we need to borrow, so we'll have one section over here that we call it adjustment from borrowing. All right. So this adjustment from borrowing will have two sections. One is principal, another one is interest. So as you can see, we are 48,000 short besides our minimum cash balance. So if we add our minimum cash requirement to this 48,000, that is going to 58,000 that way I need to have to make sure that I maintain the minimum cash balance. But I will not be able to borrow that 58,000 because that I need to make sure that I borrow in the multiple of 55,000. So the minimum amount that I need to borrow in this case would be 60,000, right? This is the amount that we come up out of 48,000. If I take this 48,000, I come to zero. I need to have at least 10,000 more, so that's going to be 58,000. And since if you round it near to the nearest multiple of 5,000, that is going to be 60,000. This is how 60,000 comes up. So whenever you take the loan, you won't repay it because you are already short of cash, and you don't repay when you're taking the loan. You only repay the loan once and repay the like interest and loan together. So this is going to be the net adjusted fund from borrowing. So we're gonna have 12,000. That is the net amount of borrowing. And if we adjust this cash surplus and deficit with the net adjusted fund from borrowing, then we'll get this ending cash balance. Oh, my bad. This is going to be 60,000 and this is going to be 12,000. And as we know, the ending balance for the month of January would be the beginning balance of the month of February. So in the month of February, we're going to have this amount. This is 192,000. And if we deduct this cash outflow, we'll have the 32,000 of positive cash balance. So if you see, we have this 32,000 of cash balance. So is this something that's more than what we're required with the minimum cash balance? Yes. So if we deduct this minimum cash balance, we are still left with 22,000 rupees. And this 22,000 can be used to repay the principal and interest. So as you can see, you need to make sure that you pay both the principal and the interest. And since you are required to make the payment of principal in the multiple of 1,000, it is clear that you cannot make the entire amount of 22,000 as a repayment of principal. So the least you can do is to pay 21,000 as a principal, and you need to make sure that the remaining amount of 1,000 is sufficient to make the interest expenses for the amount of this loan repaid. So let's see how much of the interest that would result if you're paying 21,000 with the interest of 12% for 2 months, because you're borrowing towards the beginning of the month and repaying at the end of the month. That's going to be 420. As we can say, if we pay 21,000 principal, the amount of the interest will be 420. So both the amount of principal and interest can be accommodated in this way. So we pay 21,000 as a principal, and out of 420 we'll be paying only 400. The reason is that it needs to be paid in the nearest of the 100. So altogether we'll be paying 21,400 as a loan repayment. So out of 31,000, if we pay this 21,400, that's going to be 10,600. Now this 10,600 is going to be the beginning balance of this March. So 10,600 plus 210,000, that's going to be 220,600. So if you deduct the cash outflow, that's got 28,600. All right, so we still have the money. Okay, let's get this thing aside and try to get the working note a little bit shortened up for the letter reference. Let's talk about this. So now we have this 28,600. Do we still have more than what we are going to require as a minimum cash balance? Yes. So if we get this 10,000 out of this, we have 18,600 left with us that can be used to repay the interest and loan. So let's first of all try with the nearest multiple of 1,000 for the repayment of the principal. So that can be 18,000. And let's try to figure out if this 18,000 is, like what we can pay as a principal, and the 600 would be good enough to pay the interest for this 18,000. So 18,000, 12% for the 3 months will have 18,000, 12%, 3 month we have 540. 500, oh shit, 540. So as you can see, we have a total of 18,600. Out of that, we have paid 18,000 in the principal and 540 for the interest for this 18,000. And since 540 is less than 600, that we are able to pay this amount of money as an interest for this 18,000. So let's write it down. We repay 18,000 of principal and 500 rupees as a interest. The reason that we only pay 500 out of 540 is question explicitly mentions that we need to repay the interest to the nearest of the 100. So altogether we'll be paying 18,500. That is this. And if we get this thing out, we will have 10,100 in our ending cash balance. So guys, this is pretty easy, very simple question. So this is how we make our cash collection and disbursement budget. So for budget income statement and budgeted balance sheet, we'll do it in our next video. Thank you guys.